welcome to India Decides, the FII View with me, Tanveer Gill. My guest today on the show is one of the most influential voices on global markets, Mohamed El-Erian, Chief Economic Advisor, Allianz Group, and former CEO and Co-CIO of PIMCO, the world's largest bond investor, joins me on the show today. PIMCO, of course, has approximately $2 trillion in assets under management, which is nearly the size of the Indian economy. Mohamed joins me today in his first ever exclusive interaction with the Indian media. Mohamed, many thanks for taking out the time to speak to us today. Let me begin by reflecting on an article you wrote on India with Nobel laureate Michael Spence in October 2012, titled "The West Should Pay More Attention to India's Woes." You had stated that it was still not late for India to address its issues and change course. This was, of course, at the time that India faced the risk of a credit downgrade. 18 months down the line, with the deficits shrinking and an outstanding victory by the BJP in the elections, holding out promise for effective policy making and implementation, do you feel India has indeed changed course?
Well, this was a very loud message from the Indians to the new government, saying that the economy matters, growth matters, inflation matters, and that the time had come to take serious steps. Like others, I was very taken aback by the extent of the victory. If my reading of Indian history is correct, this is the first time since the 80s that a singular government could, if it wish, have such a large majority on its own. Of course, it may go for a coalition. It is also the first time that a non-Congress party does so well. So this is a historic event, a government coming in with a very strong mandate to do something about the economy. And that is why people both within India and outside are very excited.
Right, but with this win, Mohamed, since last Friday, do you find yourself thinking and talking about India a lot more? Has the magnitude of this win increased the focus on India in investment circles?
Absolutely. Absolutely it has, and rightly so, because you do have now a very clear mandate. Now, because I'm a worrier by nature, I would caution, it's not as if everything is easy. You have an upper house that needs to go along. You need the states to be able to inline. And most importantly, the government will have to move on its appointment. It will have to take advantage of the budget to announce a very bold economic program. So there's a lot to do, but like everybody else, one cannot be impressed but to see how loud the message from the Indian citizens were.
Also, do you think that the new government has a timing advantage, given that the business and market outlook is turning positive globally? So with some amount of diligence and good policy making, India's profile as an investment destination can actually lead within emerging markets?
So in the very short term, the answer is yes. In the very short term, the Indian government will find that the external winds have gone from being headwinds to being slight tailwinds. And that's the good news. And the government would want to take advantage of that. However, over the longer term, it's really important that India control its own destiny, because the global environment is more uncertain. The West is having enormous problems getting to lift off economic growth. And India hasn't been taking advantage of the amazing opportunities that global markets and other emerging markets offer. So I would say, yes, there may be in the short term a cyclical tailwind, but the reality is that the secular outlook is still headwinds from the global economy. So it's critical that India control its own destiny.
The other talking point, Mohamed, is that with the recent developments on macros and politics, do you believe India has averted a ratings downgrade conclusively? So much so that now there is talk about how, with productive policies and revival in growth, we could potentially see a ratings upgrade. And it is important because India right now is at the lowest level of investment grade.
Yeah, so the rating issue is very important because they trigger almost automatic reactions from investors. And it's not just financial investors. Let's also forget that those who invest in plant and equipment in India, those who hire people on the ground, they look to the market measure of risk because they put that in their projections. So the credit rating still plays an important role. So you certainly want to avoid another downgrade. I don't think the rating agencies will move quickly on an upgrade until they see actions being taken. I don't think that they'll move on words. They'll want actions.
All right, Mohamed, let me get your views on the Indian economy then. There is much focus on growth revival in India. From the peak of 8 to 9%, we're struggling to defend 5% right now. Even though policymakers feel we have seen the bottom on growth, what is your own outlook on how the growth trend may look like for India going forward?
So you're right. Sub 5% growth for India is the equivalent of a recession elsewhere. Add to that inflation, so the stagflation that India has experienced more recently is a real problem. And there is no reason why India, with its opportunities and capabilities, cannot move on both sides in terms of growth and in terms of inflation. Now, the central bank has taken some very important measures that will help, but what they've done is necessary but not sufficient. The government now has to deliver. Now, there are lots of pro-growth steps that can be taken, and there's also need to build some more flexibility in the budget. If that happens, I think India will be surprised by the extent to which foreign investment responds. There's a lot of people that are interested in India, not only because of what it constitutes in terms of a market, in terms of the talent, but also because of its location in terms of knowledge and what it's able to allow people in terms of productivity gains. So if the government is able to move on growth-enhancing, productivity-enhancing steps, and they're not easy, but they've been well identified, if the government is able to move, I think people will be surprised by how quickly foreign investment responds.
True, that's fair. Some of those steps are being talked about already, in terms of project clearances and timely execution, removing bottlenecks in infrastructure projects, etc., and also allowing more long-term capital in the form of FDI. What about monetary policy support? With the concern on inflation, the RBI has refrained from cutting rates. What's your outlook on rates in India and monetary support to spur growth?
So it's important to remember where India was when Governor Raghu Rajan took over. Not only was inflation too high, currency was under tremendous pressure, which meant making inflation problem even worse, and the balance of payment situation was also under pressure, which made the rating agencies downgrade the credit rating. So there has been a remarkable turnaround in that set of issues under the governorship of Dr. Raghu Rajan, and that is really important. For him now to be able to take the next step, other parts of the economic tools are going to have to do some of the heavy lifting. India doesn't want to make the mistake that the US has made, which is to rely exclusively on monetary policies. What monetary policies do is they build a bridge for growth-enhancing policies, but they do not deliver a destination, right? They're not good for that. You cannot secure durable growth through monetary policy alone. And particularly so in India, where you really do need to address the productivity issues. So monetary policy is doing a lot of the heavy lifting. It has succeeded on a number of counts, and now it needs to be supported by what the Indian electorate is asking for, which is growth-enhancing, fiscally responsible policies.
Since you mentioned the currency, do you have a specific view on the Indian rupee? Among emerging markets, it's done pretty well. It's gained about 12 to 13% from August 2013 lows. It's been one of the better performing emerging market currencies.
So it's one of the best performing because, unfortunately, it was one of the worst performers, right? So you've had that V, and it's an important V, right? And a lot, whether the call of whether it's fairly valued or not has a lot to do with the sorts of reforms and the sort of budget that Mr. Modi's new government will introduce. What I can tell you is India wants to avoid these roller coasters. It is not good to have these roller coasters in the currency, because companies not only look at the level of the exchange rate, they look at the volatility of the exchange rate. Right. So you want to reduce that volatility in order to be able to secure long-term investments, and that can assist India's own efforts.
Fair enough, Mohammed. But that brings me to my next question. What, to your mind, then, is the biggest risk for India right now? It seems a bit picture perfect. What could spoil the party for India?
So I'm old enough to remember something very similar that happened in Mexico. There was a time when the established Mexican party, the Congress equivalent of Mexico, the PRI, got defeated, and the new party came in, the PAN, with sky-high expectations, And they weren't able to deliver. And they weren't able to deliver because going from an opposition party to a governing party is a big transition. You also have the realities of having to deliver quickly on some quick wins, people are expecting some quick wins. And then, as I noted earlier, we shouldn't forget that the upper house is not controlled by the BJP, and we should also not forget that the states are very autonomous in some key areas, and particularly in investment policy. A lot of the infrastructure programs right now in India are held up not by the federal level, but they're held up by the state level. So I think it's important that these sky-high expectations become realistic. And it's really important that the government move quickly on some early wins. And then you can get in this self-reinforcing process and avoid what happened to Mexico, which is sky-high expectations that were disappointed at that time.
Mohamed, let me get your views on the markets then. On May 16th, amidst all the euphoria, I couldn't help but feel a bit of deja vu. The event reminded me of the 2009 presidential elections in the US. The new government was at that time seen as a catalyst for change. And interestingly, from a market perspective, the US and other markets, including India, made a bottom in March 2009. The Dow is up 160% from 2009 lows. Likewise for India, we pretty much covered lost ground. Both markets are 10 to 15% higher from their 2008 peaks. It has taken the markets 5 years to recover from the crisis lows. Would you see this recovery as a correction of the sell-off in 2008, or was it the start of a new bull market of which we've already seen 5 years?
So if you see the Western markets, we've had two very different phases. Phases one was a recovery from a very sharp sell-off, one caused not only by a massive financial shock that almost brought what's called a sudden stop to the US and European economy, but also a recovery from the worst of the Great Recession. That was phase one. Phase two has been borrowing growth and borrowing returns from the future, which is very different. And the way that has happened is by the Federal Reserve venturing deeper and deeper into unconventional policies and basically trying to bring forward the returns from the future. And the reason is simple, and it's also a warning for anybody who thinks that the Reserve Bank of India can do all the heavy lifting. The Federal Reserve does not have all the tools required to generate growth. However, the political system in the United States, and Congress in particular, is highly polarized and frozen. We went 5 years without a budget, just to give you a sense of how polarized the Congress is in this country. So what the Federal Reserve has done, it has borrowed growth from the future in order to get the private sector now to invest now. In economic terms, it has used the wealth effect, artificially raising equity prices in order to generate more spending and pull up fundamentals. If that bet doesn't succeed, then at some point the US is going to pay back not only the return, the market returns, but also pay back the growth. So that's why you hear the Federal Reserve say it's very important for other parts of the public sector to step up to their economic responsibilities.
Yeah, but specifically talking about India, the stage at which the market is right now, do you think that we are pretty much going to extend ourselves into a secular bull run from these levels, one that may extend out into 10 to 13 years, much like what the Dow did between 1987 to 2000, when the Dow actually returned 600%?
So for that to happen, two things are needed. One is delivery on growth promotion, lower inflation, and broad financial stability in India. But that is not enough. You also need a very conducive global environment. I think the lesson that India and many emerging markets learned is that they are on the receiving end of the volatility that's exported by the Western countries. So whether it's the European crisis, whether it's Ukraine and Russia, whether it's the Fed changing course in the United States, emerging markets are on the receiving end of this. And this is important because India, if it does all its work, will also need to be in a supportive global environment. I tell people you cannot be a good house if the neighborhood is volatile. You also need the support of the volatility. So the bet on this is the beginning of a long-term secular Indian bull market has both a domestic component and an external component. And it's very important to remember that. Okay, it's not just a domestic component. India should have better control over its destiny, but it still lives in a global village, if you like.
Mohamed, given your vast experience in managing bonds, I wanted to know your view on the Indian benchmark as well. The Indian benchmark government bond is actively traded. Do you think that with some clarity on rate outlook and on policy making, the Indian benchmark at 8.759% yield will make for an attractive buy?
Yes. So the answer is absolutely yes, because you could see a set of circumstances that are achievable in which India flips around the growth inflation equation. So what we've had, unfortunately, in recent years is less growth, more inflation. It is, you can see a set of circumstances under the policies that are being pursued at the Reserve Bank and under the policies that Mr. Modi has hinted that he would implement, where you flip that, where growth goes up and where inflation comes down. That has two impacts on the bond market. It reduces the real rate, and it reduces the inflation differential. It allows the central bank to shift its interest rate regime, and you would expect the benchmarks market-determined rates to react positively to that. So it is very feasible for that to happen, right? And again, that's why people are going to be monitoring so closely the appointments and the budget and more generally the economic program that is announced in the next few weeks.
Well, what about Indian infrastructure bonds? I mean, they've been a big selling point for FIIs, but they're underinvested, about 10 to 15% of the total investable limit. What can make these bonds attractive in your view?
So that issue is an issue that many countries are looking at, including the United States. There has been a significant underinvestment in infrastructure, and that is undermining growth. And that is true of Europe, it is true of the United States, it is true of countries like India, it is true from my country of origin, Egypt. So that's a big issue. What's ironic is you have investors like Allianz who are looking for long-dated opportunities because the liabilities of an insurance company are long-dated too. And in fact, our CEO, Michael Diekman, wrote a very important op-ed in the Financial Times on that issue. So you have the interest and you have the need. Now, why have these two things not come together? Part of it has to do with the vehicles, and infrastructure bonds are a way to help overcome some of these market failures. Part of it has to do with the clarity that is required to invest for such a long period of time. And part of it has to do with the fact that private-public partnerships have not been as leverageable as they should be. So this is an area of growth. It's an area where we need more research, not only in India but around the world. But it is significant that there's a need and there's an interest. And the idea is to try to overcome the barriers that bring these two things together.
Let's talk about the U.S. markets then and the U.S. economy. How are you looking at the U.S. recovery and the growth story there? Quarter one was worse than expected given the weather conditions. Quarter two is expected to see a strong rebound. There's talk about, possibly 4% growth coming in quarter two. What happens next, quarter three, quarter four, and into 2015? What is the sustainable trend on growth that you foresee?
So if you look at the year as a whole, the U.S. should achieve 2.5% to 3% growth. Now, by Indian standards, that doesn't sound very high. By U.S. standards, that's actually much better than what the average has been since 2008. And as you say, it's going to be very irregular. So in the first quarter, you had a lot of adverse weather impact, and you're getting a bit of a recovery, actually quite a bit of a recovery in the second quarter. So growth will be higher. And we, for the first time, can see the possibility of a 3% growth. That's the good news. If you go beyond that and ask, but can the U.S. maintain what it really needs, which is 3.5% growth, the answer is not yet. And it's this issue of achieving escape velocity, of achieving liftoff. So the short-term prospects for U.S. growth have improved, but you cannot extrapolate that as yet to longer term because of the same issues we talked about India, which is that so far the central bank has been carrying too much of the policy burden. Now, in the United States, you haven't had this decisive political change. You haven't had this overwhelming mandate that you've had in India. So that's why it's hard to argue that the U.S. will easily achieve economic liftoff.
Also, Mohamed, what I gather from market circles is that the timing of rate hikes in the U.S. has everybody guessing, not just the timing, but also the extent of the hikes. Terminal rate, essentially, the range being touted between 2 to 4%. It would be an important signal of growth revival and also would indicate what the Fed believes the growth potential could look like going forward. How do you see the rate cycle in the US?
So that's a critical issue, is what is the terminal rate, right? In the short term, it will determine a lot of market pricing. In the long term, like you say, it's going to signal about how strong the economy is. So what do we know? We know the Fed is in a transition on the policy side. It is using less of QE, the fancy word for going out and buying securities on the marketplace. It has been reducing that, and it will get out of that business finally by the end of this year. But it is not yet ready to move. In fact, if anything, it is strengthening what's called as forward policy guidance. It's trying to assure markets that interest rates aren't going to be going up anytime soon, because it doesn't want to undermine the recovery. Now, there's a fundamental disagreement, and you've said it absolutely right. The range of where people believe the neutral Fed fund rates is, in terms of nominal, is somewhere between 2 and 4. In terms of real, it's somewhere between 0 and 2. Looking at the work that's been done, I think closer to 2% nominal, closer to 0% real, makes more sense given what else the US faces. And let's not forget that the US is still an over-leveraged economy. The household sector is still levered quite heavily, and the US hasn't invested enough in infrastructure and other growth promotion issues. So even as recently as this week, you've had one of the really influential Fed governors, Mr. Bill Dudley of the New York Fed, make that point, right? Say the neutral rate is going to be lower than what we have seen in the past. So that is it. Now, I must tell you, there's a massive amount of uncertainty on this. There's a massive amount of uncertainty because we have been now for 6 years in a period of experimental policies. And as Chairman Bernanke reminded us back in 2010, there are not just benefits, but there are costs and risks. And there's lots of things we don't know because we've never been in such an experiment for such a long time. So there's a lot of uncertainty still out there.
Sure. I also wanted to ask you, what would the Fed move on rates mean for emerging markets? Because that's a bit tricky, especially for liquidity. First with tapering, then tightening.
Yes. So that is a major risk, okay? And the reminder of last May, June has to be taken very seriously. So if you take the tape back, wind it back to last May, June, all that happened was one word was mentioned, taper. That's all that happened. One word was mentioned. Now, it wasn't just that emerging markets sold off. Those of us who were in the front line will tell you the scary thing was they became dysfunctional. Market liquidity, as you know, evaporated. There was no willingness on the parts of the intermediaries to take on risk, to warehouse risk. And therefore, you got this massive reaction. Now, that is a reminder of how dependent we are on this policy-induced liquidity. And it's very important to remember that. What does that mean for investors? Is that you should price a bigger liquidity premium. You should expect to be paid more for potential illiquidities during periods of market shock. Right? And that is a very, thank you for raising it, that's a very important point.
And finally, Mohamed, before I wrap up, I can't let you go without asking you your top 3 money-making ideas for the rest of 2014.
So first, I think that one has to recognize what you said earlier, which is that Western markets have come a long way, right? So one has to be cautious on Western markets, right? This is the time, in my mind, to have some dry powder, because as we've seen, there's going to be quite a bit of volatility. And you certainly don't want to be a seller that's forced to sell by enormous volatility. So a little bit more caution, less enthusiasm on Western markets. Second, let's not forget the extent to which developing markets underperformed last year. Now, yes, there's been a recovery, and you pointed to India. There's also been a recovery in Brazil. But still, the differential hasn't been made up totally. So if you find countries that are seriously implementing a reorientation of their growth model, because that's what India is going to be trying to do. It's going to reorient its growth model. When you see countries like that, those are opportunities to take advantage of. The third issue is look to where the crowds are not. Don't just run after public markets. Look also for various opportunities. So there's a lot of venture activity going on in India. and around the world that is of significant interest. There's going to be a lot of completion of markets. The mortgage market is an example of opportunities in some developing economies. So don't just focus on the public markets. Also look at these other opportunities, okay, because they're not as crowded as the public markets are right now.
Mohamed, thanks very much for joining us and giving us your views on India as well as the world. I really appreciate your time. With that, we come to the end of this edition of India Decides, the FII View. Thanks very much for watching the show.